Hello, everyone. Today on the final bar, we do our normal Friday routine, which is break down the market from three directions: top down macro, bottom up stock picking, and sector rotation in the middle. All through the wrap the week segment, we focus on how the picture has changed from last Friday to this Friday. And we look at from a top down, from a bottom up perspective, you'll see that overall it's a mix of short term distribution, but within the context of longer term uptrends. We're going to talk about separating the short term noise from the long term picture. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the markets using the power of technical analysis, the power of stock charts. I was watching an interview earlier this week, or listening to an interview with Chris Verone, who's a technical analyst at Strategas Research Partners in New York. He did such a great job on the CMT Association's podcast describing the methodology of the technical analyst, but the benefits of getting away from the narrative, breaking free from the restrictions of what should happen or what could happen, and focusing on the evidence of price. And that's really what we focus on this show, talking about the patterns in price, breakouts and breakdowns, really focusing on trends, where they're headed, and when we start to anticipate trend changes. And now more than ever, I think, as the equity markets arguably have rotated from a period of short-term strength and really long-term strength to a period of short-term weakness, the question becomes a question of risk management. We bounced a little bit today for sure after yesterday's acceleration to the downside, but in the end, I think the damage has been done. And we'll talk about some of the downside targets for the S&P 500, what that might look like, and how to think about it from a technical perspective. We have great guests on this show. We had a lot of fun this week with a number of our guests. Yesterday, it was really fun to talk with Jeff Weiss, who was one of my first mentors in the industry. Next week on Tuesday the 5th, we have Craig Johnson, who's the technical analyst at Piper Sandler in Minneapolis. Next Thursday and Friday, I will be on vacation taking the family to the woods of Oregon. But we have two fantastic guest hosts lined up for you. On Thursday the 7th, Julius DeKempener, founder of RRG Research, will be taking the show on. On Friday the 8th, Tom Boley from earningsbeats.com. And I know most likely both of them and their work. They do a fantastic job. On October 12th, by the way, the Tuesday after, Ari Wald, technical analyst at Oppenheimer in New York, will be joining us. Also wanted to let you know the Money Show is coming up on October 5th. It's actually running October 5th through 7th. That's next week. I will be presenting a segment called Behavioral Finance, How to Avoid Confirmation Bias. What we're going to talk about is confirmation bias. This is one of the sneakiest and most common biases that I found that investors run into. We'll talk about how to recognize it coming up into your process, how to use charts and technical analysis to minimize its impact in your decision making. If you don't understand what I just said, you should go to that session. It is free, and it's through the Money Show's virtual expo. Go to stockcharts.com/money show to sign up for that event. Let's continue on today's show with our Wrap the Week segment. This is my favorite part of the week, although I probably say that in a lot of times because I love a lot of what we do on the show. It's a lot of fun to put together every day. But on Fridays are especially fun because we get to look back and see how the market's evolved. I want to start with a poll question, though. We always have a poll running on our Stock Charts live stream on stockcharts.com, also through social media. And we asked you recently, will the next 10% move in the S&P 500 be higher or lower? And I thought this was absolutely fascinating. It was almost a 50-50 split right down the middle between higher and lower. And talk about a market being in transition phase. Talk about indecision and being more common at the end of a bull market cycle. It's fascinating that was the response we get, and I'm not super surprised. And if you think about it, a 10% move above current levels. Assume we asked the question today. We're around 4350, just below 4400. So you had another 400 or 430 or so points to where we're at. We're back up to pretty good rise from where we're at now. That would take us to new highs for sure, up in the 47, 4800 range. You knock down another 10%, and that's actually getting down here. That's getting below 4,000, right? So it's interesting that given the choice of breaking the 200-day to the downside and breaking to new all-time highs, and then a lot more, it was literally split halfway. It's interesting. Had I asked that question, we have asked that question pretty often, every couple months or so. The last time we asked it, it was much more highly skewed to the higher side. I don't have the number in front of me to say, but this is certainly a change in sentiment. It mirrors the change in the dynamics of the market that we've seen. Let's continue on our wrap the week segment. What we like to do to start with is we'll talk about the market performance today. We'll just talk a little bit about how the market played out here on Friday. We'll quickly move to the weekly returns and look at how the week has evolved, and then we'll go through the Mindful Investor live chart list and see how much progress we can make, breaking down some of the key themes in price breadth and sentiment. So the S&P bouncing higher today, sold off a little bit out of the open, but by the end of the day, it really had pushed back onto the upside. Now, it's worth noting after yesterday's distribution and the distribution earlier this week, we didn't even make it to yesterday's high. So this was not a everything's all clear. We're back and all is well again. This is more of a very reasonable bounce higher. And if you think about the decline going into quarter end, this may be a time when people are putting the cyclical trade back on, getting back into things like energy and materials, and you can see some of those stocks bouncing up pretty well so far or during the day today. The Nasdaq was underperformed a little bit, but still positive. And the Nasdaq 100 was up 0.7%. Mid caps and small caps both outperformed the large cap index, with the small cap index, the S&P 600, up almost 2%. And the VIX is back nearing 21. Elsewhere, we have interest rates that actually come off here, and today they spent most of the day in a steady decline, back below 1.5% on the 10-year yield. And I think a big part of the bullish financials thesis, if that's what you're buying into, would be this line certainly going higher overall. Totally reasonable to get a bit of a bounce higher in bonds, which is what we got today. But overall, that's certainly something to pay attention to if you have that sort of bet on the table right now. And the dollar index coming off a little bit. We've talked about that head and shoulder, or sorry, the cup and handle pattern on the UUP and dollar sign USD. That's the bullish dollar ETF and the dollar index that we have on StockCharts. Gold essentially flat is a pretty choppy session for the GLD, but silver really pushed to the upside, gapping higher today and spending most of the day elevated pretty good, up about 1.5%. Commodities as a whole certainly moving higher, and the DBC really finished in a position of strength today. The energy sector, the top performer out of the 11 S&P sectors today. Cryptocurrencies, as I always say, if you love volatility and love uncertainty, I'm sure you find a very happy home trading cryptocurrencies, because plenty of volatility. Ether up over 10% from yesterday at this time. Bitcoin up almost 10%, and Bitcoin is just breaking above 48,000 as we're shooting the show live here just after 4 p.m. Eastern. Yesterday it was around 44,000, so this is a 10% jump just in the last 24 hours, and you can see the acceleration overnight, but then the push higher through the course of the sort of business hours here in the U.S. Let's look at the weekly change and how things have evolved. So we're starting the clock last Friday. We're going to where we're at today, and let's look at the major asset classes. If you follow my cursor and my voice, you'll be able to track what all has happened. Here's the S&P 500 in black. So large cap stocks finishing the week down 2%, 2.2% actually. So again, today's bounce, let's put it into a little broader context this week. The week overall, fairly weak. It's one of the worst weeks we've seen on the S&P in certainly quite some time. And again, a nice bounce today. And again, the longer term trend in the S&P 500, as we'll see from the market trend model, still very much okay. But it's the short term weakness that I think is pretty compelling. So reasonable to have the bounce today, Friday, going into the weekend, into next week. That will be the real question, is whether you see further deterioration in terms of price. Only one thing underperformed the S&P this week, and that was the NASDAQ 100, down 3.6%. Everything else was on the upside. So vertically from the S&P, we have bond prices, which were down 0.9%. Very close to that, you had emerging market stocks, which are down just under 0.9%. In purple, we have small cap stocks, which finished the week down 0.3%. That's using the Russell 2000 ETF. Everything else was in the positive for the week. Gold was up 0.8%. The US dollar index, or using the UUP, actually was up 0.8% as well. And then the top performer in this group's crude oil, up 2.8%. So we talk about energy stocks, and when I'm screening for stocks, I ran a couple screens this week, but yesterday I was looking through some of the stocks making new highs and new lows, and plenty that you're finding in energies. Actually, I was writing a note for clients this morning, and the three top industry groups, if you look at the scooter rankings by industry, And I'm trying to think of the right order. I think number one was coal, which is a pretty small group. It's not a lot of market cap in that group, but that's bucketed under energy stocks for us. Second was aluminum stocks within the material sector. The third were E&P stocks, exploration and production within energy. So the top three, all energy and materials, and again, finding some decent breakouts in some of those. When we add Bitcoin into the mix, you can see it's by far an outlier to the upside. Last couple of days have certainly pushed to the upside. I've heard whisperings of a short squeeze in Bitcoin, accelerating things to the upside. I don't really have any expertise to speak to that part of what happened in the last 24 hours, but I can tell you the chart has certainly gone up in a big way with Bitcoin up 12.2%. And I think it's worth noting a lot of those charts, given the rise that you have in a week like this, it's a change of character. I feel like day to day, and when people ask me about Bitcoin and Ether, I usually will start with an hourly chart just because the time frames are so compressed. So I wouldn't be afraid to look at a daily chart to understand the long-term trend, but focus on the short-term dynamics when you can. For the rest of the Wrap the Week segment, we'll focus on the Mindful Investor Live chart list. If you've never seen our Friday show, the way you access this is go to the articles tab at the top of Stock Charts, go to my page, which is called the Mindful Investor. There will be a button at the top of my page that says live chart list, and that will get you to this list of stocks, which you are welcome to peruse at your leisure. The first one is the market trend model. So this has three different time frames. It's all based on weekly data. And this is something I have running in the background for large cap stocks and then a bunch of other things as well. And it's just a way to track the overall trends and just think of it as three time frames and just what are the trends telling you. Again, it's not a predictive model, in my opinion. It's more of a trend following model. It tells you where the trends have been. And then you use that as an inspiration to dig deeper and identify where the opportunities may lie and where you need to manage risk a little more effectively. The long-term model turned positive over a year ago. This was in June of 2020, has remained positive for a while. It's been sloping downwards in the last 5 months or so, which is in line with the medium trend model, which actually gave a sell signal in May and has remained bearish since then. So for me, the model doesn't turn negative until you cross the zero line. So the long-term trend is still very much positive. And I think that's worth noting when you look at charts like Microsoft and Facebook, a number of them bouncing okay, like Alphabet today is bouncing okay off of recent weakness. But again, think about the long-term trends. This week doesn't change the fact that overall these have been long-term creators of wealth. The long-term price and relative profiles are still in good shape, which is why I think you could still have more potential downside in names like that and still be within the context of a long-term uptrend. And that's what the model right now is sort of suggesting. We're still within the realm of a reasonable pullback, certainly a deeper pullback than we've seen so far year to date, but certainly within the context of a normal bull market cycle. You should and normally do have pullbacks, like this. It is not unusual that we are seeing this sort of pullback now, given the seasonally weakest part of the year. What's unusual is we haven't seen one yet. It's taken this long to do it, and the short-term model has been negative since late August. And really, it talks about the short-term deterioration in prices. So overall, the model is long-term positive, medium-term, and short-term negative, and it tells me to think more cautiously than thinking about new ideas right now on average. Now, the daily S&P chart, I would argue, along with the daily NASDAQ chart, has certainly rotated from a position of strength to a position of weakness. Nice bounce today. And if you know your candle charts, you actually call this a bullish harami pattern, if you want to look that one up. If you know the bullish engulfing pattern, which is a big down bar and then a big up bar, and day two actually engulfs the range of day one. And I'll show you this. This chart actually makes the candles a little more obvious. Here we go. So in a bullish engulfing pattern would be a big down day, and then the next day is an up day. But the second day's real body, the distance between the open and close, engulfs the first day's body. So you'd have to have a lower open down here and a higher close up here. That's a pretty common pattern, which indicates a bullish reversal. This is a bullish harami pattern, which is kind of similar, but the sizes are flipped. So you have a long down day, a long up day, but days two range is within the day one range. And it's also a bullish reversal signal that speaks to short-term strength, and breaking the low of today would invalidate that short-term bullish indication. So for what it's worth, that's the candle pattern that you're seeing here. Again, for me, I'm thinking about the distribution. I'm thinking about the fact that I had four things on the list: breaking the 50-day, making a lower low, making a lower high, and the RSI getting below 40. We have now in the last week accomplished all four of those, and I have to be short-term negative. So what next? I mean, I think for me, my base case, given the material, the move that we've had off of the lows, about a 5.5% drop to today's low, I could see another, double that, and it takes us down to around 40.50. That would put us around the 200-day moving average, around the 38.2% retracement level. That would be a pretty reasonable pullback. And while it would be the steepest pullback we've seen in quite some time, it would be a very normal pullback, and I think could set the stage for a nice rotation higher to show strength into the end of the year. And that's kind of the general way I'm thinking of it. I'm going to let the chart tell me what to do, though. I'm not going to predict where we may end the year, though. The S&P breadth has been fairly negative, and while the advanced decline lines have been negative for a while, they're really close to breaking another swing low. They won't do it today, most likely, but two other breadth things that I would point out to you. Number one, as of yesterday's close, only 25% of the S&P are above their 50-day. That is down from 92% about 6 months ago in April. So when you talk about the fact that we've been in a stealth correction and a lot of stocks have already broken down, are already down not just 5%, but 10%, 20% plus, this is the chart that shows you how that deterioration has really played out. We're at the lowest level we've been on this indicator, by the way, since last September and October, which was this 2-month consolidation period. I wouldn't be surprised if we have a similar sort of pattern. Remember, markets can correct in terms of price. They can also correct in terms of time, and that's something I might be looking for. Also, just wanted to point out, and then we have to move on to our next segment, is the bullish percent index for the S&P 500 is now below 50%. That's also the lowest it's been since last September and October. So when people ask me, is this just a normal pullback for what we've seen in 2021? I think I've seen enough evidence to tell me this is not a normal pullback. This is something different. How that actually plays out, that's where we need to analyze these charts going forward and see how they play relative to some of the key levels we've talked about. We need to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It is so good to have you join us every weekday after the close for our show. A couple quick announcements before we get to the Final Bar mailbag. Number one, our questions that we're going to read to you all came from you, our viewers, in the last day or two. We get a lot of great questions, and we would love to hear from you. Questions about technical analysis, particular technical indicators, charts, tickers, ETFs that you're struggling with, market dynamics, market history, whatever it is. We have some plenty of resources to help point you in the right direction. Our email is the best way to get your questions to us. It's thefinalbar@stockcharts.com. You can ping us on Twitter at FinalBarSCTV. You can hit us on our YouTube channel. Just put a comment below the video you're watching on our Stock Charts channel. We would love to get your question. Hope to answer yours in our next mailbag segment on Tuesday's show of next week. Also, as a reminder, go to StockChartsTV.com. That's our on-demand platform. You can access it via the website. Also, from your mobile devices. Great special events like The Pitch, our year-in review, our market outlook coming up in January, and a lot of great weekly and daily and regular shows. Go to StockChartsTV.com or search on any of the app stores on your mobile devices for Stock Charts TV on demand. Let us continue on opening the Final Bar mailbag. And again, your questions are always welcome. TheFinalBar@StockCharts.com is our email address. First question. Thanks for another wonderful show. Could you please help me understand how to find stocks that are in the accumulation phase? You know, I throw a lot of terms around and I talk about accumulation and distribution and consolidation and accumulation phase and distribution phase and a lot of those sorts of things. And often I probably gloss over what that actually represents and how to find those things. And I appreciate your question, trying to dig into it. I tend to think of market environments as different patterns, right? And you always think about. I think my goal, looking at a chart, is this stock or is this chart in accumulation mode, meaning it's in an uptrend. It's indicating that investors, generally speaking, are trying to accumulate shares, which means increased demand, which means the price goes higher. Or are people trying to distribute shares? Are big money managers unloading shares and adding supply to the market should cause the price to go down? So looking at the prices, you're able to identify whether a chart is in accumulation mode, which I would argue something like Target had been in from the second quarter of last year, really through the middle point of this year. And depending on your time frame, you could see this last 6 weeks or so is the chart beginning to enter into distribution mode. And those phrases, by the way, are kind of time agnostic, right? It depends on the time frame of the chart that we're looking at when I'm making that description. So for me, it is just a shorthand of saying, is this chart in an uptrend or downtrend? The main way that I would find, or the characteristics of a stock in accumulation phase would be this: in general, the price is making higher highs and higher lows. In general, the RSI becomes overbought when the stock is going up, and it does not get to the overbought or the oversold region on pullbacks. Usually, stops around the 40 level, which is classic pullback within an uptrend. Ideally, the relative strength is going higher, which tells you not just is it appreciating on a price basis, but on a relative basis. So that is the goal. Looking for a stock in the accumulation phase. How do you find it back here when it's in the beginning of the accumulation phase? One of the screens that I run all the time for my own clients at Market Misbehavior is stocks making new 3 month highs. And I look for stocks making new 3 month lows for charts and distribution phase. And what that does is it helps you identify things that are just sort of breaking out to the upside. One of the ones I was talking about earlier today is something like Western Alliance Bank, or WAL. This is a mid cap bank, basically a regional bank. And you can see it's been in a basing pattern, meaning it had a nice rally here. It's now been in a consolidation phase, which is a sideways phase, sort of bouncing between support and resistance. And now it's arguably breaking above the previous highs, breaking out to new highs. So it came up on the 3 month high screen. You can see it's rotating higher. You see the relative strength is starting to improve. That's how I would be looking for charts in accumulation phase. You can also use things like MACD and DMI and a lot of other indicators to try to do that. But that's what I would kind of be looking for. That's where I would start. Next question: can the upcoming earnings release date be included in the full quote area? And I allowed this question because I'm inviting all of you. If there are things that you would like to see our platform do that you can't figure out, please let us know. And our support desk is a great way to do that, because I will tell you, having worked with our development team, talking with the management team about how we want to upgrade stock charts over time, we put a lot of weight on how many requests we get for certain features. So if there's something that you're passionate about that you think we could do better, I would encourage you to send that to our support desk, and we catalog, I promise you, every request we get, and that's how we prioritize things. That's certainly how we help prioritize things. You had mentioned putting the earnings date in the full quote area, which I think is a really, really cool idea. We have earnings data on a limited basis. The easiest way to find it, obviously, is go below the chart. There's a simple summary page that has a lot more detail in terms of fundamental data, earnings dates, earnings data, and so forth. We have a limited amount now, and our plan rest of this year going into next year is to really upgrade the amount of fundamental data that we have and the different ways you can consume it. So adding it to our scanning engine a little more than we have now, adding it to places like the full quote, which I think could be more customizable. Those are all features that we're looking at, and I certainly agree with you. We actually added the market cap in here maybe last year. It wasn't too long ago, but I remember talking about that and making sure that we got that happen. So things like that. The other things that we should consider including, I'd encourage you to let me know. But that's how you can find earnings releases now. Next question. My process is: one, find a sector on the move, and you mentioned the XLK as an example. Number two, use the scooter rankings to narrow the field to the top 20. And number three, use candle glance feature to select stocks over their 50-day moving average. Where did I go wrong? And you had a much longer question I had to cut just for space, but I think you mentioned that a lot of the technology stocks that you were that you were looking at were not doing particularly well just in the last week or so. What's an easy way I could bring this up? Here's what I'm going to do. I'm going to say here, I'm going to look at a candle glance, and then I'm going to switch to, let's see, maybe I can get a good list. Bum, 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 bum. Yeah, maybe we'll do this. Just trying to show like a group of stocks in here. I don't I don't disagree with your plan. I mean, your general plan was start big picture and think about a sector. And overall, the technology sector has been strong. I get that. And if you look at the technology sector, it's hard to argue. In the last, if you look at take the last week out of the picture, overall, it's been in a pretty good uptrend with strong relative profiles. And I totally understand that. Use the scooter rankings to narrow the field to the top 20. I very much like that idea, because I will tell you, in any sector, regardless of what the big sectors are doing, you will find stocks that score pretty well, because that is sector agnostic, right? It throws all the stocks into a pile and it ranks them all based on their trend profile. So I think, looking, and I would say maybe don't filter it to the top 20. I would look for scooter rankings in the top 20%. I don't know if that's what you meant, but a scooter ranking above 80 would mean it's in the top 20% of all large cap stocks or mid cap stocks or small cap, whatever you're screening on. And then use the candle glance. So find stocks that are over their 50-day moving average. So I think what you did actually makes a ton of sense. I think that's a great way of combining the big picture, the macro perspective, the sector rotation, using the scooter rankings to find particular stocks, and then hand picking them based on where they're at relative to moving averages. I would just tell you, I think what you've learned by the fact that some of those stocks or a lot of those stocks have gone down in the last week is the fact that it doesn't always work, right? I would love to tell you that if you follow those three steps consistently, you will always find stocks that go higher. What I learned working with people like Peter Lynch and others, I mean, they bang the table that you're going to be wrong about half the time. A good analyst was right 50 to 60% of the time, which meant you were wrong 40 to 50% of the time, which seemed crazy, but it's absolutely true. That's what the data actually, we looked at data of stock picking, and that's what we tended to find. So the game was not to be right all the time or even most of the time. The game was when you're right, stay right. And when you're wrong, admit you're wrong and get out of it. And so I think you had mentioned in your question, again, you did a great job of, you actually recorded a video for me, which was really fun to watch. And I appreciate it. You mentioned that, you'd been stopped out. And I think that is the most important thing of your process, which I would say you didn't go wrong. I think you did very right. That approach is going to work. And making sure you have a good money management part at the end of it is going to help you get out when it's not working. And if you keep doing that repeatedly, run those screens and look for those opportunities and lean into what's working. Admit when it's not working and limit your losses. Overall, you're going to do really, really well. What that process did at the end was it got you out of something that wasn't working in the short term, and I don't think that's an unreasonable thing to try to do. Great questions, all of you. We have some more that we won't be able to get to, but we'll carry them over and we'll try to get to them on Tuesday. But we need to wrap today's show and go to the three charts in 3 minutes. Here we go. I wanted to basically for the 3 and 3 do a little something different today. I just wanted to highlight the phrase "the good and bad and the ugly" always comes to mind, but I wanted to highlight a stock that was breaking out, highlight a stock that was sort of consolidating, highlight a stock that was going down. I didn't think that I was going to be mirroring one of the questions about the accumulation phase. But I think what you're arguably going to see here is a chart in accumulation phase, a chart in consolidation phase, and a start in distribution phase, or basically one going up, one going sideways, one going down. And it's meant to illustrate that you get those patterns pretty much in any market if you know where to look. A chart breaking up, I mean, I'm finding a lot of examples in energy, things like DVN recently breaking out. In financials, and I think WAL is a good example of some of the strength that you're seeing there. Now, again, I'm asked, are you assuming rates that go a lot higher, and that's why you're making that bet? Perhaps, I mean, that certainly seems to be something that would be a tailwind to this chart as rates going higher. That's probably going to be good for a stock like WAL. But again, the technicals, the charts don't need you to determine the narrative. They need you to follow the chart. So if the chart's breaking higher, that tells you whatever conditions need to be met for the stock to go higher are being met because the expectations are going up and the price is going higher. And that's the goal, in my opinion. So price breaking to new highs, relative strength improving. That's a good example of a chart breaking out. Chart in consolidation mode. This is Disney looks a lot like Netflix before Netflix got good here in the last couple of weeks, sort of broke out of a long-term base. Disney is still in a basing pattern. We talk about Disney back here when it was testing the resistance from July and August. And I remember looking here and saying, wow, if it can get above these previous highs, that's a really encouraging sign. It did not. It actually came down, and now it's once again testing the lower end of the range. We're bouncing off of around 168 again, back below moving average support, which has now become a bit of resistance here. And I think Disney is range bound. What's easy about a chart like this is one of two things is going to happen eventually. Either we break below 168, and this confirms a downside trajectory, most likely, or we break above 188, and that would get us above the resistance that we've seen over the last 3 months. One of those things happens, and waiting to see which direction the breakout occurs could tell you a lot about the most likely direction next. So that's a chart in consolidation mode. Last one is a chart in distribution mode or breakdown mode. I think ROST is a good example. I immediately thought of things like consumer staples, and I thought of apparel retailers, and I think ROST is a good example. I would argue this is what's called a complex head and shoulders pattern. If you want to dig into your pattern rule book, so that's a head surrounded by two right shoulders and two left shoulders. It's almost three, but you get the idea. It's more of a broader base, but with one high in the middle. You've broken the neckline, which I think you've done. You've now retested it and rolled over. I think we're testing support now going back here from January, but overall, this is a chart that's leaning more negative, and the relative strength is going consistently down. That's a chart in distribution mode. Folks, that is our show and a wrap for this week on the Final Bar. I want to thank you so much for joining us every weekday at the close, live at 4 p.m. Eastern, as we break down the charts together. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.